All right, welcome back. This is the Real Estate Roundtable with IPRG, and we're here to talk about things that we find interesting in the New York City real estate market. Today we have Zach Ziskin with us, who is a director here at IPRG in our Manhattan market. So thanks for joining us today, Zach.
Absolutely. Glad to be here.
Happy to have you here.
Also goes by the Big Tuna as a nickname in the office.
Thank you.
Yeah. We have to, yeah,
Why? Why the big tuna?
I don't know.
I eat a lot of sushi.
Is that what it is?
Omakase, sashimi,
Yeah,
whatever's
sushi.
available.
Still, you're eating a lot of sushi?
I spend quite a bit of money on it.
Yeah.
Even
nice.
in an economic downturn.
Is it an economic downturn?
I don't know. Maybe not. We'll have to see.
So, all right. So we're here to talk about things we find interesting in the real estate market. I guess start off like any I don't know, anything interesting, any deal stories. What are we seeing?
We're still seeing deals happen, not at the pace that I would say most brokers are used to, but we're definitely going into uncharted territories, and I think now more than ever, you just have to keep your head down and just keep going forward and try to make as many deals happen in this environment.
What does uncharted territories mean?
I just think, look, if we were to go back into history, I'm sure you can find something that's equivalent. But like for most people, last decade we've been in a low interest rate environment. Particularly, it's been seller markets. Buyers have been paying big numbers, and I think for the first time, there's a lot of uncertainty that's in our face with where rates are going. No one knows. Where's the economy going? All signals are showing downwards.
Mm-hmm.
So I think there's a lot of negativity, to say the least, in today's world.
Yeah.
And it's our job just to make transactions still happen.
So, does that make this a buyer's market?
I think buyers are pitching that idea. Now,
Do you think it's a buyer's market?
I don't necessarily think so. And I'll tell you why. My
Do you think it's a
opinion,
seller's market?
I don't think it's either. I think it's a market where the fair deal will get done. And what I mean by that is, you're no longer getting buyers speculating on pricing. I think it's pretty standard today where it is. The rents have essentially settled. With rent stabilization, there's no more value add. So I think considering where rates are today, if the numbers can work, depending on whatever metric the buyer is looking at, the seller's going to have to accept the terms. And if they want to sell, they're going to sell.
I can add on that.
Yeah,
I find that education is extremely important for owners that I'm dealing with, many of which are not first-hand owners, second-hand, third-hand, generational. They got into the building because they inherited it, or they're business owners and they kind of fell into being that landlord. But they really need to understand that while there's an emotional connection on the seller side, buyers don't feel that way. This is a financial transaction.
Mm-hmm.
The numbers have to work. If we're selling a corner, 2B, mostly free market, where there's a lot of juice left on the table because the units haven't been upgraded, then I think it's a great opportunity where we can get buyers to compete and pay up on price. So I agree with what Steve said.
And you said it nicely there, and just to make it just even more straightforward, it used to be where if you brought a building to market, there was a range of offers, right? You had your buyers that stuck to their lower end metrics that you might have disagreed with, as opposed to the people that were speculating, paying $500 to $1 million more than those buyers. Today, when you bring a building to market, you're pretty much getting all offers at the same price.
So, all right, it's an interesting concept, okay? Because we talk about, and this isn't what I was planning on talking about in the least bit, but I find it interesting. Buyer's market. Is it a buyer's market? Is it a seller's market? How do you define one versus the other? Or is it just a fair market? And I get it. A year ago, prices were much higher and cap rates were much lower. But, did that make it a seller's market? I get that the seller would sell for more, but the buyer is borrowing for a lot less. So it was a fair transaction based on just where the market efficiencies ended up being. Now interest rates are a lot higher. Prices are a lot lower. Does that make it a buyer's market? In my opinion, not particularly, because buyers are still having to pay for it through the interest rate. So it's just an efficient, fair market, spot that we're at, and the market moves in that way. Luke, any thoughts? Buyer's market, seller's market?
Yeah, no, I think it's a good point. I like the term fair market because that's what I feel like it is. I don't think it's a buyer's market. I don't really think it's a seller's market. honestly, there's a lot of everyone's really playing the waiting game. You know, in brokerage and in a sales transaction in New York, there's a long road ahead, right? You accept someone's offer, and the attorneys start talking, and the attorneys discussing and negotiating contracts is taking a really long time. I don't think of buyers like rushing to get comments back. I think they're waiting to figure out, you know, where their interest rates are going. And yeah, I think it's a fair market. I think people are getting fair deals. I think the people that are actually going to transact could theoretically, in hindsight, be getting good deals. But these are only going to be good deals if interest rates come back down to levels where historically they were in the last 5 years. There's also a shot that the interest rates that we experienced in 2015 and 16 and 17, like they're never going to get down to that point again, and maybe they settle out at like a 5% interest rate, and these buys they're pretty on par.
So that's interesting, because if you owned a building I operate in New York City, so if you owned a building in New York City 5 or 6 years ago, you were being offered prices that just don't exist in this environment today. Right? Interest rates were artificially low. Buyer speculation was extremely high. And since that point, we've had law adjustments in 2019. We had a pandemic. Now we're in a rising interest rate environment where a lot of banks won't even touch deals. So that's why I think it's really important to explain to that owner of a 10, 20, 30-year holding period what's happening in the market today. That's really the most important thing. What's happening in the market, how to make sense of a deal, and really where they could put their proceeds. Because it's not easy to manage and operate a building in New York City and in Brooklyn, across the
of course.
It's a challenging thing,
Proceeds are a big one.
And what Luke said, it kind of jumped out. It's a slow market in a way. If I can describe this market, it's fair and slow.
So,
and just real quick, what I mean by slow is, the Fed's meeting again, I think it's early December and then late January. There's no reason for someone to hop on a deal unless it's an absolute home run and checks every box, because things could potentially change in December and January. So people are dragging things out.
So what's causing it to be a slow market? Like, I remember in 2009, it was a very slow market because there was a whole liquidity issue and there wasn't any cash in the market.
Yeah.
My view is that that's just not the case today in the least bit. Right now, liquidity is not the problem.
No.
Just to add one thing, I was on the phone with a buyer last week. They said they have $25 million in cash and they want to go buying buildings. And they think they have a competitive advantage because they literally could close all cash. And I don't think that that's a competitive advantage. I don't think that we're in a market where there's liquidity issues. So what's making the market so slow?
Well, hold on.
Yeah.
I think that buyer is in a unique position.
Okay.
I get it. A lot of people have money right now, but they're not spending it. They're not really investing the way they were, halfway through this year or the beginning of this year. And people get loans, and that's why the hike in interest rates affecting the market so much. I do think people are still going to get loans, and someone with that kind of cash can do terms that no one else can do. They could say things like, I'll sign a contract in a week and I'll close in 30 days. Anyone getting financing is not going to do that. And if you have the cash, you can. And a lot of sellers today, because of all the BS that we're hearing in the market, people taking too long, retrades happening, you can run the gamut. If someone's throwing terms around like that, I'm going to tell my seller to go with that person, and that's an advantage.
But what I think, Derek, is, and correct me if I'm wrong, because I've been hearing it too, that I'll close all cash quickly. I think what they mean is they want a discount on pricing today because they have that. And I'm not seeing that advantage.
This guy wasn't even saying he wanted discount on pricing. In fact, he was saying that he paid a premium in a way. Like, he's, look,
I
told him, he was asking where pricing is getting done. And I was saying, like, a lot of the people I'm speaking with are saying that they need neutral leverage. So, obviously people want positive leverage where their cap rate is higher than their cost of capital. We saw previously when there was upside in deals, people were taking on negative leverage where the cap rate going in was less than the interest rate, their cost of capital. But what I'm hearing across the market from a lot of syndicated raised funds right now, they're willing to go in on deals, but they want neutral leverage. So
makes sense.
If the interest rate is 6.25%, they basically are offering 6.25% cap rates. And this all cash buyer was basically saying, maybe I can undercut the market in terms of yield. So instead of being in neutral leverage, a 6.25% cap rate, he's like, maybe I could just come in at a 6% cap rate, close all cash. I don't have to deal with positive or negative leverage impacting my return on investment throughout my hold. And he's like, this is a way that I can get deals that otherwise I couldn't get.
Mhm.
I don't know if you guys have any thoughts on that, and then we'll get back to what's making this a slow market.
I like the business model. I think if you are truly behind what you say in that aspect, you're going to find deals.
Yeah.
I think New York City, the run up we've seen, and just the optimism in the city, to get a 6 cap is a great deal. And you're looking for the future. Now, it's hard to do that with today's leverage, but if you have all cash, it's a no-brainer. Just because cap rates or interest rates get up to like 7 or 8%, like it's hard to say the city's going to be at those cap rate places that they were in the past when the city wasn't where it is today.
I also see deals where financing just doesn't necessarily work. I represented an estate sale on the Bowery, great thoroughfare across Chinatown, and it had a retail component and then 2 office floors and some air rights. And the situation was we had tenants and subtenants in there. So the rent roll the numbers just didn't work. I found an all-cash buyer in the local community down there who had 4 other buildings. They were representing cash for 2 other families. It was an all-cash transaction at $5 million. They closed. They had some money left over to go renovate and reposition the upper floors, and then they'll probably do like a cash-out refi situation there afterwards. But it just didn't make sense on the books for a lender to borrow the amount of money you needed to buy this deal. It just didn't really work.
So what you just said, I completely agree with, and that's my point to you.
Mm-hmm.
A lot of these deals, especially the value add deals, like what Zach is talking about, financing today with these high interest rates, it does not work. So someone with $25 million in cash can make a lot of deals work that other buyers cannot make them work. So they're going to get a better deal just because the competition isn't there. For a heavy deal, we have one right now. We have a building in a prime location. It's vacant. Needs a ton of work. This is historically a deal that would fly. We did well on it, but it didn't have the attention that it normally would have. And that's because I think the financing right now, especially for construction, is really, really tight. Interest rates are really high, and people aren't willing to like jump into some big value add play. They're more they want to see something more with cash flow. And the reason they want to see something with cash flow is you can actually go to a bank with that. So again, going back to my point, a lot of people don't have $25 million cash to do these types of deals. Then there's an opportunity.
I hear you, but this $25 million in cash, they weren't looking for these like big value add deals or these heavy lifts. They were looking for like free market 2B buildings, like cash flowing stuff, or properties that are mostly free market with some rent stabilization component. But I didn't really think they were in much of a competitive advantage in that space.
It just depends. I mean, it depends where the rents are. They have an advantage. There's not going to be a big buyer pool for a deal that that financing won't support. People don't get into this. Most of the buyers we're dealing with, there's a lot of raised capital, a lot of syndication. They're not buying deals all cash. So something has to make sense where they can either sell it to investors or sell it to a bank.
So what are the deals where the financing does make sense, that can be financed, or there's a lot of, call it bank liquidity or debt liquidity? And what are the deals where there's not a lot of liquidity and an all-cash buyer is going to have a real advantage?
Who wants to take that?
I think based on our conversation last week, I mean, banks are still lending as long as it has the debt coverage ratio.
Cash flow.
I don't think anyone's without cash flow, unless it's like a redevelopment, I don't think anyone's buying. It's hard to say an example of, a deal, maybe if it's under 100 a door or something like that, but they still need some cash flow. Or just extremely cheap bricks that they're willing to park their money for a very long time.
But let me ask you, what about your cash on cash return? Mm-hmm. Because if I'm only getting 50% leverage on a purchase, whereas 5, 7, 8 years ago I could have gotten 70, 75%, I've got to put a lot of cash into the deal. And if my NOI is going to basically cover my debt service, my cash on cash is going to be very low. I mean, I'm seeing that on deals that I'm working on, correct? Correct me if I'm wrong. Where maybe the numbers don't necessarily work out.
Where the returns are lower. Some people look at cash on cash return and some people don't. And that also goes back to just like, is it positive leverage? Is it neutral leverage? Is it negative leverage? And how does that impact your return on investment? But I mean, if you can get a positive cash on cash return where the cash on cash is higher than the cap rate because you have the benefits of positive leverage, those are ideal deals. But historically, it's hard to see it. It's hard to see that in New York, where your cash on cash is much higher than your cap rate.
Yeah,
Agreed.
I also think the days of the high LTV deals, 70% and up. I think that's done. I think you're starting to see a lot of the old school. I mean, I was at a bank event last week. I was speaking to a guy that has a lot of units. He had some age on him for sure, so he's definitely been doing it for a long time, and he had a big portfolio. And he's historically never put debt over 50% on any of his buildings. He's never had any issues, and that's the way he buys real estate. And those types of people this is a normal thing. 70% LTV, 75% LTV. I mean, that can get you into trouble, and I think these low interest rates was really buoying that, but I don't think it's going to happen so much anymore. Does that make sense?
Yeah, no, it makes sense. I mean, LTV is a function of price. I mean, you can get a better LTV at a better price, but if you're still paying a big number,
Yeah.
And the cash flow is not there to support the debt, then you're looking at a low LTV type of situation. I mean, I know we have this transaction in Manhattan right now where it looks like the financing's coming back at like 50%. So
Right.
maybe that is the scenario where people are buying. I don't know the exact math offhand, but if you're buying like a 5 cap, a 5.5 cap, maybe with the debt coverage ratio and all that, how it plays out, maybe the financing is at like 50% or 55% LTV, and again, that's just a function of price. Maybe in that scenario, you could say the person's overpaying, but maybe the person has a different view in terms of where they see the property going over the hold.
And that's going to slow things down. I mean, a lot of these, I keep saying syndicators, but that's the groups that we're really dealing with in New York. If they're having to put down that kind of cash to buy deals, their deal flow is going to be way down. They don't have that kind of money to buy as much volume as they've been doing at 50% down. So, I mean, a lot of these people were doing 75% or 80% down. They were buying a lot. That's going to come right down too. I mean, how can you have a business plan of buying deals where these people are buying for fees and all this type of stuff? If you're only buying 2 to 3 deals a year, there's no business there. So I think that's going to slow down.
We spoke about this last week with the mortgage broker Jason Au as well.
Yeah.
But if like refinances are slowing down and just the amount of like capital that's being deployed into the market slows down and people aren't able to execute on the cash out refis the way that they have been, then there's just like a vacuum of liquidity in the market, which is going to mean there's less demand, and that's going to mean prices are also adjusting that way. So it's very interesting, all the dynamics that are at play here. But getting back to the top where we started the conversation, so we've been putting deals under contract. We've been selling deals. And I'm just wondering if there's anything interesting on any of these deals, any new deal stories, anything that we've noticed. I guess I could kick it off real quick in terms of, I know that we closed 2 deals last week, both vacant 2B buildings. So that happened. We put a 20-unit rent stabilized under contract. There's that. I know there's a bunch of other deals we're working on, vacant land, industrial, multifamily redevelopment stuff. So just I don't know, any thoughts in terms of what we're seeing, any trends in terms of what's interesting out there?
So I think you have the 2 vacant buildings that sold. I think one was in Astoria, one was in Park Slope. Value add needs to be vacant today. That's one of the or free market under rented, non renovated.
Those were
So these were
the
just
Park Slope one is rent stabilized, fully rent stabilized.
vacant though,
Vacant,
right? So
correct.
and so was I think there's 6 family
Yeah,
in
the
Astoria.
6
So
family was rent
so again,
stabilized,
these are sub rehab plays. So we've been talking about it for the last couple of months now. You have the
Yeah.
sub rehab avenue. We closed a couple of smaller 3 units last week that were fully renovated. There's another play. And then the 20 unit was in central Brooklyn under contract. It was a 6.75% cap rate. It was 7 times the rent roll, $105 a door, and $128 a foot. It's a cheap deal on paper, but it was fair considering today's environment. Back to that fair statement we made earlier. It's just, if the deals make sense, they're gonna sell. So I think the hardest part about today is just getting sellers on one spectrum, buyers on the other, to meet at that fair price. And once they do, they're sold.
It's just so crazy how within New York City there's like so many different asset classes within the asset class. Like you have this 20 unit selling for 2.1 million for a 20 unit building, and I'm just remember looking at the closings that we had this morning that we went through, and we had this partially free market, partially rent stabilized vacant 6 family in Astoria that sold for 2.2 million. So it's a 6 unit in Astoria selling for 2.2, 20 unit selling for 2.1. I mean, we've sold, I think we sold a 3-family for the same price that we sold the
Last week
the
on,
20
in Bushwick, yeah, it was
Bushwick.
2.2.
So there you go. It's just so interesting to me the multiple asset classes within the asset class and
For
just how
sure.
that plays out in terms of pricing and where demand is. Zach, anything on the deals that you're seeing?
Yeah, I mean, going back to what I initially said about the education,
Yeah.
with sellers, I'm negotiating multiple contracts right now, and I'm looking at paperwork very carefully, to the point where it's not just the IAIs that we had to show proof of prior to 2019 that the destabilization hit the threshold properly and we have supporting evidence. But I'm seeing, I mentioned this to you, TPU audits. I mean, there's just a lot going on that normally a broker might not even pay attention to. It typically just kind of gets negotiated between the attorneys.
Could you explain what TPU audits are, what that stands for?
Sure. So it's Tenant Protection Unit,
Okay.
an agency of the New York State Homes and Community Renewal. So it's basically just governing, the rent stabilized units and if they were properly converted, and just kind of monitoring and checking in on landlords to make sure everything's done properly. And you have to have substantial evidence to prove that those units were properly destabilized. And I'm selling this building on the Upper West Side. They bought this building in 2006. We're selling it now 16 years later. These units were destabilized prior to that '06 date. So this owner didn't have all the leases, didn't have the supporting documentation. He had put money into these units. He put $50,000, $60,000, $70,000 into these units, but we just don't have the paperwork to show it.
Yeah.
So there's some risk there. If there's a challenge on regulatory status, it could become an issue down the road. So those are just things that we have to look into.
Do you know what triggers a TPU audit? And how the TPU gets involved?
So-
And is it building wide or unit by unit?
So the way I've seen it on some of the units I'm working, it's a significant jump. It's a jump, and again, I don't know the ins and outs of it specifically, but I've seen units that have gone on like a 3 or 4 bed from 1,500 to 6,000. That's a significant jump where
Got it.
you have to put $80K into the unit, plus you get all the vacancy bonus and all of that. So I don't know exactly how the system works. We'll have to look into that, but a lot of those units would get red flagged.
I don't know. I don't really know either, but I heard from a few people that it's like a timing thing. Like units done after 2017, they're really looking at.
So the last
2017.
5 years.
Yeah.
They're combing for rent increases.
Yeah, like people really want. If you want to buy if I was buying a destabilized deal or a building that had some free market units in there, you want to see those things you want to see them been destabilized for over 10 years.
Right.
I think that's a safer bet than something that was destabilized in like 17 or 18, because
And
then
we're-
you're gonna get.
We're still having conversations. It's funny about leases, and it was never a thing. 20 years ago. Oh, I've got to hold on to leases. Most landlords figured if I had 5 to 7 years, like when I file my taxes, I need a couple of years just to show some history. Now you need 20 years, 30 years, and landlords just don't have that. So it's intrinsic risk for a buyer to take that on and figure out what to do next.
It's bullshit too, because they keep changing the rules.
Yeah.
And then you have to abide by those rules that weren't the case a few years ago.
For sure. There used to be like the 6-year look back,
it's insane.
and you didn't have to keep records beyond 6 years. Now you have to keep records back however many years, whatever that is. So it's a tough environment in terms of just conveying what you have and demonstrating to buyers that a unit has had the rent increased or became destabilized and how that happened. It's just a lot that someone has to go through.
When I put a building up for sale in New York City, I sit down with my seller and anybody who's been involved with the ownership of the building, and I go through, I have a checklist, and I go through everything that we would need in order to have a seamless sale. And I'm going to tell them, I'm going to say, listen, buyers are going to look for X, Y, and Z. What do we have? What are we missing? And let's figure out how we can move forward, in an efficient manner.
Yeah.
And so we'll look through what we have and what we don't, and there's a lot of violations, HPD and, DOB and ECB. And so there's a lot to look through, especially on bigger apartment buildings. I'm selling, nearly 80 units, 5 buildings over in the East Village. We have another portfolio that we're going to be listing soon. So these are just things that we really want to pay attention to in this market.
Yeah, really good to do diligence that stuff as a broker before you go all the way down the road and have to deal with like marketing the property and walkthroughs and just spinning people's wheels. Only like there's nothing worse as a broker to like not do your basic homework up front and then to like waste your time, waste people's time, and just get it down the road only for something to come up that easily could have been discovered if you just like took a little bit of thought or time to get everything that you need.
And everything's worth something, right? I mean, I don't want to say, the price is going to come down millions of dollars, but if we're missing certain items, it can affect the price. It really can.
It definitely can. Because all of a sudden there becomes a risk element to the deal where there's like an overcharge or some kind of fine exposure, and then all of a sudden you have to start quantifying that risk of potentially the unknown.
Exactly.
So, all right. Anything that you're seeing on any of the deals you're working on, Luke? Anything interesting?
I think these guys.
I know you have the warehouse and some other stuff that we're working on. Anything coming up?
We could throw back some like a different asset. Like you're bringing up this like a warehouse, right? Like a lot of these development sites that we're selling two in Williamsburg. One is in like a Gowanus location, and environmental stuff is coming up a lot, and that's something that you have to get around in a hurdle. But I honestly think land's a good asset type to sell. It's a lot easier, and you don't have to really deal with all the yellow tape that they deal with some of the other stuff. But those are still moving, surprisingly.
Do you think land is being impacted by 421A? The lack thereof?
We're not really, in the markets that we focus on, like me, we're not seeing it. Like, we're doing 3 decent-sized land deals right now, and it's all condo.
All condo.
All condo. But I'm sure...
Are you hearing anything about the rental build-to-rent market?
I'm sure with the price of construction right now, people are telling me that rental plays do not make sense if you're paying these prices per foot without a tax payment.
Yeah.
So,
For sure. And it's not even these prices per foot, because that's applicable, it seems like, throughout the entire
it's also
market.
construction cost.
Yeah.
It's construction cost. Plus, there is... Listen, maybe in like a Flatbush market or a Prospect Lefferts market, it's different because the price per foot for these sellouts are way less, or when you buy them.
Yeah.
But prices are not light on land deals, like in Williamsburg or in a good location in Brownstone, Brooklyn. They're not. They're pretty expensive. They're like hovering around like where the peak was. Like we're selling deals for right around $400 a foot. I mean, those that's a high watermark.
So this is interesting. Let's just talk about this for a minute. So on cash flow deals, we've seen cap rates go up significantly, which means prices have come down significantly. I don't have the calculator in front of me, but you can just say a 1 point move in cap rates is
definitely
a big percentage in terms of price. But you're saying on land, we're not seeing that move for, I guess, development for condos?
Very weird. I don't have the answer.
On that?
I don't have an answer, but it's 100% a fact. Like we're selling a deal right now in Williamsburg. It's like kind of like I don't know the right term, but it's right below the BQE. It's not north side, but it's very good. We call it the Italian section. It's a big Italian neighborhood. Very, very strong market. You have 2 good L trains there, 3 good L trains there. I think the market there is extremely strong. We've done a ton of business there. And we're selling 2 sites right now at $400 a foot. Those are big, big numbers. Those were in the height of the market. We're selling for those prices. We sold one earlier this year when interest rates were going up for like $415 a foot. So I don't have an answer, and you would think with interest rates going up to where they're going, condo sales would be impacted, which would bring down like the price per foot because now interest rates are so much more expensive, and these are condos that are selling for $2.5 to $3.5 million on a sellout. I think that price range, I mean, you're getting financing there. So it should affect it, but it's not. And construction costs are way up. Everything with developments right now is aiming to a decrease in prices, and we're not seeing it.
Have you spoken with any of these developers, any of your clients, about like why
they're paying so much now? I haven't asked them.
No, well, like
Are you scared?
You asked them?
Very scared.
But what about asking them like? I mean, I had this conversation with the guy. The guy called me. He has a condo building he just rolled out in Park Slope, and I was asking him kind of in-depth questions about like what he's doing because he's got a number of other developments under construction, and I just wanted to get his take on the condo market. And he said that demand is less, but I got the strong opinion from him that prices haven't come down at all. And yeah, I mean, he says that, he's selling condos in like the low $2 million, mid $2 million range, and my sense is there's a lot of demand, a lot of capable buyers, and the buyers can afford it, and it seems like the product is not enough product, and yeah, it seems like the condo market for that stuff is very strong.
That's where I'm probably wrong because I'm just assuming that condo prices are going down because of interest rates, but I don't actually know. And it was just an assumption. And if that's the case, and the condo prices are still strong, then that supports the values.
So I think it's a market by market thing. I'd be curious to figure out someone that's in like the residential condo sales field to get like their input.
Actually.
just because you have to imagine, like my gut tells me, like luxury Manhattan, 10 million plus, it's had to have taken a hit. You'd imagine.
I think it's the opposite. The condo guys that I've spoken to, they don't really see people getting loans over $10 million. When you hit $10 million, people don't really get loans. They just buy them in cash.
I guess what I'm saying is like there's certain submarkets of Brooklyn that are very strong right now. There's some that are non-existent. Like I think it's very
For
market
condos.
specific. Yes.
I agree. Like I think Bushwick, I heard there's things are really sitting. I think that's a
Condos are now selling to rental buyers because they can't sell out
Condo
as
buildings.
condos.
Yeah.
boom.
And you're not seeing that in these other areas, which I think it's because, call it a Williamsburg, Greenpoint, you probably have people that aren't spending the $5 million they would have spent in Lower Manhattan because of the rates.
Yeah.
They're now going to spend $3.5 million.
I'm in a market that's littered with townhouses, right? You live down there, down in Greenwich Village.
I do.
Everybody wants to own, a finished, gut-renovated single-family or two-family. The challenge is the delta is so extreme right now to buy a finished product versus to buy an asset, a 6-unit, a 10-unit, vacant, unrenovated that I can go in and reposition and convert to single family and either sell out or live there if that's what my goal is.
Yeah, I think to get to finished product in New York City is so hard and
So hard.
So many people. I live on 11th between 5th and 6th, and just walk down that block. The same 6 townhouses that have been getting gutted for the last 3 years. It doesn't change. Like they literally cannot finish projects. I watched a guy. There's a house next to me. It was Adam Newman's old house. So the guy that used to own WeWork, he took it down to the studs and then sold it. The guy who bought it paid, I think, like $15 million, and this is like a shell. And he started doing work on this at least a year and a half. I saw the guy roll up last week. He got out of his car. His driver was waiting for him. He looks at it, shakes his head, gets back in his Range Rover, and leaves. Like he was just like, "What the hell is going on?" I saw it all over his face, and I would be thinking the same thing if I were him. And there's like 5 different houses like that on my block that just have been under construction. The finished product, I don't know what's going on in New York with getting things renovated.
That's why the delta is so extreme.
It has to be.
Like people will pay a massive premium to not have to do that work and not have to go through the headache. And honestly, leave the real estate development up to the real estate developers.
Yeah.
Like these people that come in and they've never done it and they want to convert a 6-family or 10-family to like a 1 or a 2-family, and they've never done it before, and they don't know who a good architect or expediter or contractor is, and they don't have the right team, and like I don't know, I'm sure they get the deals done, but it's a heavy lift. I mean, we've watched this. I mean, as being brokers, we've watched this from the front seat for a very long time, and there's people that are very good at it, and there's people that really struggle with it. But I feel like we're bouncing around a little, and I don't have a ton of time left. I have a call that I have to hop on in 15 minutes. I just want to see if we're starting to see any creative deal structures. Like a lot of people have been bringing up assumable financing. A lot of sellers will bring up assumable financing. They have 3 years left on a loan. It's at like 3.5% interest rate. You guys see anything there? You think that's an advantage? I'll throw that out there. Or people have been mentioning seller financing, stuff like that. Or just like what kind of avenues are we seeing in the market these days?
So I always go back and forth with the seller financing or the assumable loan. And it's because you're essentially telling the buyer to buy at inflated prices because interest rates are low. But then what happens in the 3 to 4 years when that runs out, or the 5 years when rates don't return? So it's like,
I agree.
Why would I take
I
on?
agree as well.
Yeah, why
Artificially overpaying.
Why would I?
Sweet,
That's
thank
the word. Why artificially just to keep a lower rate?
Yeah.
How about I buy what it's worth today and I'll pay the higher rate?
Yeah.
I was at a real estate event like 2 weeks ago with a very sizable multifamily owner in New York City, Manhattan, Bronx, Brooklyn, and he was just like, "What's up with all the assumable financing deals?" He's like, "These people keep sending these to me."
Yeah.
And it's like they're almost trying to trick him to be like, "Hey,
Yeah.
man, pay a 4.5 cap on this because there's 3.5% interest rate on this for like the next 3 years." And he's just like, "Well, why don't I pay the prevailing market rate and just buy it that way?"
Now, I like it if there's a value add play, and you don't want to pay 8 to 12%, probably 10 to 15% to a hard money lender. The seller can probably get a premium on their price if they do the lending. To me, that makes sense when you get creative, but to just get a straightforward deal at a lower interest rate and tell them to pay more, it doesn't make sense.
the holding paper thing, obviously, as a buyer, you would love that.
Okay.
Depending on obviously the term, right? If the seller's willing to like hold like 80% and they're willing to do it like at a real interest rate that's like a right around market, obviously any buyer is going to jump on that. But for a seller, like that would scare the heck out of me. Like I think it's risky.
Go ahead, Zach.
Well, what about a situation where there's heavy vacancy and let's just say it's a mom and pop owner and they don't have any debt on the building and they're trying to hit a certain price that might be at the top of the market, and then I think it's an interesting situation where they can hold back a couple of $1 million over a 3 to 5 year period and maybe undercut the debt market. Sellers have asked me that.
Have any of you been involved in a sale where the seller held paper?
It's been discussed.
But I actually,
I've been one comes to mind, and the buyer did it behind our backs at closing with the seller, and he got a 1% interest rate for 10 years.
I have a better question. I know exactly where Derek's going with this. Has anyone been involved in a deal like this and had the seller actually say it's a good experience? That's the real question.
No, what I'm trying to say is...
So I have an example. I mean, this is a deal that I did in, honestly, it was 2015. It was an apartment building. I had a great relationship with the seller. Luke was involved with the seller as well. Mm-hmm. And I had a great relationship with the buyer. So I felt like it was a match made in heaven. Perfect. And the seller lived out of state, and he wanted to do seller financing. He wanted to like still make some money off his money. So sold the property. He held paper. I want to say it was like 70% LTV and like a 3.5% interest rate. It was a 5-year loan. So the 5 years comes up in 2020. The buyer, who's now the current owner, calls him up and is like, hey, whatever, I don't want to refinance and take you out. Can we just extend it? So they agree to extend it for like another 3 years. Now here we are in like 2023 or whatever. Cap rates are up. The values are down. Interest rates on the refinance are up a lot. And the buyer, the owner, I mean, he can't like help himself in a way, but all he wants to do is retrade on the loan that he borrowed. And the price that he paid in 2015, no one else was paying that price. So he paid the price, he bought the deal, but now, fast forward 5 years or 8 years or however long it is, he gets to come back and go for the retrade that far in the future. He takes another bite at the apple down the road, and for that reason, I just think it's a bad position for the seller to be in. Like, what are the seller's options when they hold paper? Like, the guy is either going to retrade, or what are you going to do as the seller? He lives out west, on the western United States, and he's probably in his 80s at this point. He's going to like file for try to foreclose on this? Like, no way. So he's in a very bad position.
I also think you have to look at why that person is selling to begin with. If I'm selling because I don't want to manage units anymore and I'm dealing with, the intricacies of owning multifamily in New York, I want to do a 1030. A lot of my clients do 1031 exchanges. They want hands-free real estate out of New York. And, we tried to put together a creative deal where they held some paper, but it screwed up the exchange for the seller. And they had to cover, they'd have to cover that money, even if they had a first loan on the property that they were selling, their down leg. So it can be a little complicated. I don't know if it necessarily works. It can in certain situations.
Yeah. I would never do it as a seller. After seeing what I've seen, I would just never put myself in a position where the buyer or the owner can play games with me, not pay. Why do I want to become the bank all of a sudden? We talk about these people that are buying these townhouses, like leave the development up to the developers, like leave the real estate lending to the banks. Like, don't pretend to be some lender all of a sudden. Like, take your equity, go do something else. And the buyer is responsible for coming up with their own money to close the deals.
Yeah, I agree. I think there's way too many things for a buyer to do there. You're opening yourself way. The best case scenario isn't that great, and the worst is very bad.
The best case scenario is not great at all. I mean, this guy got 3.5% for the past however many years, for sure.
Wow.
Anything else you guys want to bring up? I'll bring up one last thing. If there's
The floor is yours.
So I'm starting to think that these properties with free market units and rent stabilized units could be an interesting play in the market. I feel like there's so much demand for free market that like the yield just gets compressed on that stuff. And there's like such a lack of demand on the rent stabilized stuff because there's just no way of knowing what's going to happen in terms of values and is there going to be any growth or upside down the road. And I mean, that asset class has been hit so hard. And it's like a hard pill to swallow to like buy a fully rent stabilized building when even at a 6 or 7% cap rate, where you just don't know what the exit strategy is or what the growth potential looks like. But if you buy a building that's got, say it's an 8 unit, 5 free market, 3 rent stabilized, you get the free market cash flow and growth potential. Then on the rent stabilized portion, like if the laws ever loosen up, there could be a decent chunk of upside within that segment of the property. So it's kind of like the best of both worlds in that way. And I just wanted to throw it out and see if you guys had any opinions or thoughts there.
Yeah, I could comment on that. So I found that so the free market part of a building is so valuable today more than it's ever been because of the changing rent laws. So I've had buyers actually request that sellers keep free market units vacant, and they'll pay them over the contract period whatever the market value is of that unit, so they can go in after closing, renovate, and create an even greater unit that they can charge more rent for.
Yeah.
So I'm noticing that on these partially free market deals where it's just the value of that, 40, 50% free market piece of the deal is just that much more valuable. I will pay you to keep it vacant for the next 90 days so that I can go in and add value and reposition it. Mm-hmm. So that I just note that's an interesting point.
Yeah.
So I have like a love-hate relationship. Like we call them like the hybrids, right?
Yeah.
So as long as there's like a minimum 50%, in theory I love it because it's basically the safest hedge with the most upside, as opposed to the guys that are just buying strictly rent stabilized, hoping the laws will change or something like this. You're basically riding any kind of rent increases, and then one day if the rent laws do change, you get the upside there too. I find the hardest thing is on these buildings, a lot of them were pieced together, and having the supporting paperwork or documents to prove the free market status, they never truly get the value they probably deserve.
Let's assume that they actually have a good paperwork file and the units are in fact free market for the sake of this conversation.
Yeah.
I know we can get caught in the weeds.
I think it's a great asset to go after.
Yeah.
Because the whole market is essentially shifted towards free market buildings. Mm-hmm. The demand's through the roof. And it's ultra competitive with a lot of private equity and syndicates. But if you can basically, hedge yourself against fully stabilized and get some that, you still have a good building, renovated units, and then you take your rent increases on the rent stabilized while you can turn into a pretty, hopefully, in the next 5 years, like a double-digit yield on that investment today.
They could be great buildings in great locations, and you're probably getting a little bit better going in yield than for other categories within the market.
And hypothetically, you're getting a discount, right? Like you get an 8-unit in Williamsburg that's free market as opposed to an 8-unit that's free market and stabilized. In some situation, you might be paying 50% less. And in terms of like the metrics of price per foot, price per unit, growth, GRM, it all makes sense at that 50% discounted metric analysis there.
I think it's an interesting avenue in the market where we haven't seen a lot of people looking.
I think I agree with everything that was just said. I mean, it's very interesting, and I think that there's a few things that make people not want to look at them. One being that there's a rent stabilized component, which people don't like, and the other is, there's some like sex appeal taken out of the deal, right? Like, oh, they already worked the building, and those stabilizers are never going to leave, and they're smaller deals. A lot of them are like 6 units and 8 units. So when if the building's in a good location and people aren't paying attention for those 2 reasons, that's when good deals are to be had. I think when there's not a lot of competition, a lot of people writing offers on deals, and for those reasons I just listed, I think you could find yourself in a good deal with these hybrid type properties.
Yeah. All right, great. That's it for my notes. Is there anything else anyone would like to add?
We could go on and on and on.
And we will. And we do.
I think that Tuna was an excellent guest. It's good having him.
Thank you.
Yeah.
Great to be here, guys.
Yeah.
Sure. Appreciate it.
All right.
Just say happy Thanksgiving to everyone.
Yeah,
and,
happy Thanksgiving.
All right, this will
That's
probably
all.
post after Thanksgiving.
All right.
But happy
Okay.
holidays.
Happy holidays.